let's turn back to the inflation report, because it came in a lot hotter than expected, jumping 0.5% in January, much more than the expected 0.3%. Annual inflation rate is 3%, and that core rate, which the Fed looks at, was at 3.3%. That was a lot more than the 3.1% expected. Brian Belski joining me now. Brian, I just have to ask the cause of this. We weren't expecting it. I am thinking that a lot of it has to do with all of those billions of dollars that the Biden administration was throwing out before they left office. Am I wrong?
No, you're not wrong. Good morning. Thanks so much for having us. I think investors have to kind of remember three things. Number one, we're looking at yesterday's numbers, not going forward. Number two, CPI is not even the preferred measure with respect to what the Fed looks at. Of course, it's a data point that they look at, but PCE really the key thing. And I think much has been made with respect to the seasonality. If you look at the last 3 or 4 years, CPI usually in the first quarter is up. I think with the measures going forward in terms of especially on the commodity side, and when you take a look at oil prices, if we're going to increase more supply on WTI, which is Western Texas Intermediate oil, fuel prices are going to be going down. I think that's another big part, David. Now, if you also take 2 steps back and look at what we're spending our money on, I mean, never discount the U.S. consumer, man. We love to spend money. And if you take a look at travel was actually up again in January. So this experiential type of spending money, I think, is going to continue. Again, you know, the supply demand of throwing so much money at things, which was your question, is the root of this problem. It's going to take probably longer than everybody thinks. But I believe this overreaction is yet again part of what we believe is too much macro fascination in terms of these data points and kind of ultimately leading to a buying opportunity, we think, in stocks. Yeah,
and I think it strengthens two hands of the Trump administration. On the one hand, DOGE, because if you ever have a cause for lowering the cost of government, this inflation report is it. And also for the tax cuts, extending those tax cuts. This gives more ammunition that with the extra pressure on companies to deal with this inflation number, you got to at least lower the cost of their taxation.
Yeah, I think what the biggest thing people are missing in this, David, is with respect to when you look at an asset, when you look at a company, you want to look at how that company is operating. Yes, you look at earnings growth. Yes, you look at valuation. Yes, you actually look at the performance of the company in terms of price. 3 out of the 4 things that we look at in terms of our process, in terms of looking at markets, sectors, and stocks, by the way, how we run portfolios. But that third part, in terms of the operating performance of a company, all DOGE is looking at is the operating performance of the federal government. Debt to equity, free cash flow, return on invested capital, return on equity, and that's the part that's really going to be cleaned up. And oh, by the way, there's certain parts of the country, and companies, by the way, that the best signals are when return on equity and operating performance begins to improve. And what we're going to see likely going forward the next couple of years is the operating performance of the U.S. government is going to be a lot better.
Yeah, but we also are, at least for the next couple of months, are going to see these rising interest rates very quickly. How much of a problem is that for investors?
I think it's a problem because there's too much focus on Fed funds futures that, oh, by the way, have been wrong for 2 years, David.
That's right.
Number one. Number two, I think the big thing is that earnings. Everyone's complaining about PE ratios, but guess what? Earnings are going to be going up pretty dramatically, and I think that's going to send the PE down.
Brian Belski. Good stuff, Brian. Thank you so much. Appreciate it.